Hello, I'm Kamal Santamaria. This is Counting the Cost on Al Jazeera, your weekly look at the world of business and economics. This week, China. 2016's only a few days old, but it's been a turbulent one for China's roller coaster stock markets. We'll look at how moves by the regulators there to cool things could actually be contributing to the problems, and if policymakers are caught in a vicious circle. Also this week, Saudi Arabia and Iran. Diplomatic ties have been broken, trade links severed, and angry words exchanged between two of the world's top oil producers. As relations hit new lows, we'll take a look at what it all means for the oil market. Plus an island paradise or the Greece of the Caribbean. Puerto Rico's run out of money to provide key services, and the governor's warning of a humanitarian crisis. Hello everyone and welcome to 2016 on Counting the Cost, which is already looking interesting in the economic world. We thought oil was looking pretty big this week, again. But developments in China have really taken centre stage as the world's growth engine shows more signs of stalling. Start on the first trading session of the year when stocks fell on the back of weak economic data. And then, despite government efforts to calm things down, they fell further. What happened then was an automatic market shutdown, a sort of economic circuit breaker which halts trading once the market falls more than 7%. In theory, it stems the flow, but the problem is it happened again, this time triggered by a depreciation in the Chinese currency, the yuan or renminbi. By Friday, the circuit breakers were ditched, and to calm currency markets, China's central bank intervened to support the currency. That backtracking alone shows China is caught in something of a vicious circle. Now, it's not definitive by any means, but it'll show you an interpretation of how the system is working, or indeed not working. So let's bring it up here and start with the fact that China's economy is slowing. This is a known fact, and most importantly, the Chinese government knows it. So it devalues its currency, the yuan, and as a result, Chinese exports become more attractive in price. The rest of the world buys more of them. So far, I've got to be honest, this circle actually isn't looking that vicious. But a devalued currency also unsettles the markets. It makes investors wonder, well, if the government's taking that sort of action, which was only supposed to be a one-off, then is the economy actually slowing at a faster rate than we thought? And then the dominoes begin to fall. Investors sell off their stocks. That triggers this automatic market shutdown, which we've seen twice now. There's basically all this intervention in what China wants to be a free market. But when you're intervening, then it's not really free, is it? Perhaps most worryingly, it raises more questions about China's economic policies and whether this intervention is actually working. Now, yes, China's now suspended the automatic market shutdown, but that does not break our circle. Ultimately, we come back to those fears, and they are increased fears by now, about China's slowing economy and its potentially massive impact. Well, Charles Horn's joining us from Beijing to talk about all this. He is the Economy Portfolio Manager with consultancy firm China Policy. Charles, we need to go back to the causes here, because doesn't all of this really start with the currency devaluation and the general lack of confidence in the Chinese economy?
I think there's a lot of uncertainty in the market right now. As for the currency devaluation, I think it can be read two ways. I mean, following the renminbi's SDR inclusion on 30 November, we expect the renminbi to become more marketized. So we don't expect it to maintain par with the US dollar, particularly after the Fed raised interest rates. The question is, how far will it devalue? Is that devaluation because of fundamentals, or is that from domestic panic and capital flight?
Isn't the problem, though, Charles, between, again, these currency devaluations and then the market cutoffs, which we saw, and then both moves, which we've now seen reversed as well, that China has been micromanaging its economy here and really hasn't been doing a very good job of it?
With regard to the stock market circuit breaker, yes, they're very much trying to micromanage the amount that the stock market can fluctuate on a daily basis. I mean, remember that every individual stock can only fluctuate 10% on a daily basis before trading shuts off to begin with. And so this is already very sensitive. I mean, by comparison, the New York Stock Exchange will only shut down for the day if the S&P 500 drops 20%.
All right. The theory, and this is going back to the currency again, but the prevailing theory is that the currency devalues, the exports become cheaper, and that is, of course, good for the Chinese economy, which is slowing down. Do you think, though, they will really start to see some effects from that?
Globally, we're entering a period of weak demand. So I think it will take a lot more than a slight currency devaluation to really boost demand for Chinese exports. And remember, the currency is devaluing relative to the US dollar. That doesn't mean it's devaluing relative to world currencies.
All right, that's Charles Horn joining us from Beijing this week. Charles, thank you very much. China is, of course, the world's second largest oil consumer, and weakening demand there is threatening to prolong a year-long oversupply in the crude market. Energy markets have also had a volatile start to 2016 after a major diplomatic split between Saudi Arabia and Iran. The Saudis executed a Shia cleric who was revered in Tehran. The result was a cutting of diplomatic and commercial ties and more destabilization across an already tense region.
We decided to cut off all diplomatic relations with Iran. We will also be cutting off all air traffic to and from Iran. We will be cutting off all commercial relations with Iran, and we will have a travel ban against people traveling to Iran.
It doesn't matter if they cut off ties with us. We have plenty of broad relations, and God willing, we'll further expand them. Nevertheless, we should be watchful not to allow them to spread propaganda and say the reason for severing ties is lack of security for them in the Islamic Republic, which is absolutely wrong.
Let's bring in Dr. Mamdouh Salameh in London now to talk about this, international oil economist and a World Bank consultant on energy. The Saudi Arabia-Iran relationship, it has obviously been fractured by recent events, but tell me about the history of these two countries, though, in the oil markets and how there have been, tensions anyway between the first and the fifth biggest OPEC oil producers.
Well, since the establishment of OPEC in 1960 in Baghdad, Saudi Arabia and Iran have been great rivals inside OPEC and outside OPEC. Saudi Arabia is now the leading member in OPEC and the leading producer and exporter. So it has a lot of sway inside OPEC, and that explains why Saudi Arabia has managed to persuade OPEC not to cut production to absorb the glut in the market, which is estimated at 2.2 million barrels.
Surely Saudi Arabia would want the price to go up as well, even if it doesn't want to lose market share as you're talking about. Surely it, and actually all the OPEC members, would want the price to go up instead of hovering around, $30 a barrel these days.
That's very true, but Saudi Arabia is waging an oil war against Iran, against U.S. shale oil production, and also preempting Iran and Iraq asking for bigger production quotas in the future with an OPEC.
You used a phrase there at the start of that answer, oil wars, and I've actually heard this from you before. I've got a quote here where you've said the 21st century would be the century of peak oil and the resulting oil wars. Now, that's an easy phrase to say, oil wars, but can you explain to me what it would actually entail, especially if we're looking at the likes of Saudi Arabia and Iran?
Saudi Arabia's current oil strategy has 4 objectives. The first objective, as I mentioned, to defend their oil share. The second objective is to harm Iran's economy in their proxy war with Iran over its nuclear program and Iran's intervention in Syria, possibly in Yemen. Third, preempting the future demand by Iran after lifting the sanctions and by Iraq for a bigger OPEC quota for production. And the fourth objective is slowing down, if not killing, U.S. shale oil production. These are the objectives of the policy. In doing that, Saudi Arabia is waging an oil war because that's the only weapon it has against Iran. If they wage that war, it means they are refusing to cut production, they are letting the glut in the market increase, and it will harm Iran's economy because Iran's economy needs a price of oil of $130 to balance their budget. But mind you, Iran has managed during the last 2 years to reduce the impact of oil input on the budget.
Just quickly, when do you think we'll start to see the effects. And I guess what I'm talking about here is when the actual sanctions might start to lift from Iran, after which we would obviously have to watch the results very closely.
There are certain groups in the United States with vested interests who have never accepted the nuclear deal with Iran, and they will prevaricate through the interpretation of the clauses of the agreement. For instance, they might say, we are not going to lift sanctions on certain industrial entities in Iran because the Iranian Revolutionary Guards are involved in it. And that sort of prevarication. So maybe the European sanctions some of the European sanctions might be lifted in 2016, this year. I doubt the American sanctions will be lifted in 2016 or even 2017.
Dr. Mamdouh Salamed joining us from London this week talking oil. Thank you for your time.
Thank you very much indeed.
And still ahead on Counting the Cost, Volkswagen. Yes, the emissions cheating scandal still has plenty of mileage, but the car maker's also saying sorry with new, clean, green, all-electric machines. One's even called Buddy. We'll introduce you a little bit later on. Right now, though, Sri Lanka, a country which, following the end of 25 years of civil war, has seen a big uptick in tourism numbers. In fact, in 2015, almost 1.8 million of them, which is up 17.8% on 2014. Of course, it's good for the economy, but the money which foreigners bring in on an ad hoc basis like that, well, it only does so much. So the government, which was elected a year ago, is now trying to turn Sri Lanka into a destination for foreign investors. The 2016 budget contains several foreigner-friendly laws, you might say, the most important being foreigners, and that's individuals or companies, will now be allowed to own Sri Lankan land. Originally, it was going to be outright freehold ownership. Now it'll be 99-year leasehold, but there'll also be the removal of a 15% land lease tax. Also, a new Exchange Management Act is in place, which relaxes the restrictions on taking money out of foreign exchange accounts. This was an impediment to direct foreign investment. And foreign companies which own land and 51% or more shares in their company will now be allowed to keep those holdings. Previously, they were forced to reduce them in favour of nationals or just to sell the land they own. So how might all this play out on the ground rather than just on paper? Manel Fernandez reports now on what the changes mean for expats who want to be part of Sri Lanka's booming tourism industry.
Surveying their property, Sri Lankan style. Rob and Paddy bought this plantation in Valigama 5 years ago. Both investment bankers, they felt the 50-acre tea and cinnamon plantation would be a good investment. But that wasn't the only reason.
When you're in Sri Lanka, it's always a little bit of heart as well as head, because at the end of the day, the country is so beautiful, it has so much to offer, that in itself is a key attraction.
The couple are among a growing number of foreigners who have invested in Sri Lanka. Properties in the historic Galle Fort, beach villas and ancestral homes like this one are popular choices. But restrictive rules and constant changes regarding ownership had been a concern.
The government make changes very often onto what a foreigner can and can't do, what are the benefits of doing things, tax breaks, and that's an uneasy situation at times.
Despite that, demand has driven up prices. One real estate agent told Al Jazeera that the cost for a 25 square meter block of prime beachfront land had gone up from $700 to $15,000 within a few years. The number of foreigners buying land in Sri Lanka has risen sharply, especially in recent years since the end of the war here. With land ownership laws being relaxed, analysts say that number is likely to increase further. Ivan Robinson is a British property advisor who has lived in Sri Lanka for 15 years. He says he's confident that the changes will spark further interest.
I think there will be probably a lot more interest in the market over the coming year because the government will finish drafting the new laws by the end of February, and they have promised to relax or lift the restrictions on foreigners buying property.
As the country begins courting foreign investment, analysts say stability is vital.
We expect this government to maintain a stable environment over the next 5 to 10 years. bring in a lot of clarity so that the investors know exactly the kind of environment that they're dealing with and the returns they can expect.
Rob and Paddy have ambitious plans for their plantation and hope a stable new investment climate will help them achieve them. Vinay Fernandez for Counting the Cost.
Well, Sri Lanka's largest industry body is the Ceylon Chamber of Commerce, and Anushka Wijasena is the chief economist there. He's joining us via Skype from Colombo. Anushka, it strikes me that since the war ended, there's been all this talk about the tourists coming back, but really what the government's now saying is it wants to solidify that. Not just about the tourists coming and going, it's actually about proper investment.
Yes, I think there's a very clear focus on foreign direct investment, especially bringing in foreign business delegations, trade delegations. We've had top-level delegations come from Japan. A lot of countries that had sort of stayed away during the last few years. We saw a very handful of countries, particularly Chinese investors over the last decade. But since the change of government earlier last year, a big shift in the type of countries, investors that had been here many years ago, the Japanese, the Americans, we're seeing them coming back, and the government really pushing this foreign direct investment drive.
What can they bring? I mean, what sort of business, what sort of, basically, why would Sri Lanka want more foreigners coming in? I want to know about specific industries here.
I think Sri Lanka's strategic location, geographically along the east and west trade routes, make it a very strong contender for industries, for enterprises looking to locate in this region. Sri Lanka has a free trade agreement with India and Pakistan, and it's looking to expand that to cover services and investment. So Sri Lanka really provides really good hub for logistics and transport services in this region. Tourism, of course, will continue to be a key investment draw. In fact, after the end of the war, the only noticeable jump in foreign direct investment was to the hotel and leisure industry, property development. The government has a big megapolis plan for the city of Colombo, so there's likely to be a lot of investment opportunities in new urbanization around the capital. So really it's uncertain in terms of manufacturing yet, because Sri Lanka is sort of caught between low wage destinations as well as the higher innovative destinations. So manufacturing still remains a little tricky, but on logistics and hub services and tourism, maybe even some value-added agriculture and fisheries, there is a lot of untapped potential.
Anushka Wijasena, we thank you for your time this week on Counting the Cost. To another tropical island now, this time one in big financial trouble. The US territory of Puerto Rico is out of cash to the point where it's now looking to Washington to step in. Puerto Rico owes $70 billion to creditors, mainly Wall Street bondholders. Actually, it's defaulted on some of that already. But as it is a US territory, Puerto Rico can't declare bankruptcy like the state of Detroit did back in 2013. The problems all stem from successive governments issuing more and more debt to cover costs, and so it's now having to introduce austerity measures. But the creditors who bought up bonds knew there was a gap between Puerto Rico's economic activity and its debts, and it's those hedge funds who are likely to force it to pay up. Not a good situation at all, and perhaps no surprise then that Puerto Rico is now being described as the Greece of the Caribbean. Robert Ray has our report now from the capital, San Juan.
The island paradise of Puerto Rico is kicking off the new year, defaulting on debt payments.
The debt is unpayable. Some of us here in the Senate were saying that since 2014.
Local Senator Ramon Luis Nieves says Puerto Rico cannot stop the crisis until Washington helps.
In order for us to pay for the debt service, we will have to sacrifice essential services for the people of Puerto Rico.
How are you?
Trying to pay down debt, the island has slashed healthcare and public transportation services. They've let go of 30,000 public sector workers, closed over 100 schools, and increased the sales tax by more than 50%.
No matter what side of the aisle a politician is on here in Puerto Rico, if you talk to them and you ask them what is the reason for the recession and the massive debt, almost all of them will point to a 1996 act of Congress that cut corporate tax incentives. And by the time 2006 came along, most of those big companies left the island.
Puerto Rico's Governor Alejandro Garcia Padilla, speaking exclusively to Al Jazeera, described what happened next.
that there was a tool that Puerto Rico had to bring investors to the island, to bring factories, to bring manufacturing to the island. They shut down that with a 10-year phase-out period that ends in 2006. What happened in 2006? We get into recessions.
Puerto Rico's jobless rate is 12.5%, more than double the national average of 5%. Last year, 84,000 people left the island, and 1,000 more joined them each week, most headed to the U.S. mainland. And then there is the 45% poverty rate, clouding the future of the working class.
So a crisis that took decades to develop will not be solved from one day to the next one. So for them, I know what they are feeling. I'm with them, and it's because of them that I'm trying too hard to fix this crisis that we inherited.
The debt load has been building for over a decade, and the long-term outlook appears bleak with more payments due in the coming months. The only hope, say officials, if Congress allows the island to restructure the money owed and start from scratch.
Finally this week, Volkswagen, the German automaker which is being sued by the US Justice Department. Not a great position to be in, so time for some good PR. First, it said it was sorry for cheating on its emissions tests, but VW also launched several new clean energy concept cars, including a microvan named Buddy. Rob Reynolds has more from the Consumer Electronics Show in Las Vegas.
Volkswagen rolled out a new electric car it calls the e-Golf Touch, a vehicle executives compared to a smartphone on wheels.
These new technologies will provide Volkswagen customers with entirely new levels of convenience, comfort and freedom.
VW's consumer vehicles chief, Herbert Diess, demonstrated what he said was the car's intuitively designed dashboard.
There's no need to keep switching back and forth between different menus. That's my idea of simple, safe, and fun.
The company also presented a futuristic take on the old VW bus called the VW Bud E, with a host of interactive features like voice recognition.
Please open the passenger door.
Okay, the passenger door is opening.
But there was no ignoring the elephant in the room. The VW pollution cheating scandal, revealed last year, which affected 11 million diesel vehicles implanted with software designed to defeat emissions testing.
We disappointed our customers and the American people, for which I'm truly sorry. We are doing everything we can to make things right.
The unveiling came just days after the U.S. Justice Department announced it was suing the German carmaker in civil court.
The government alleges that more than 600,000 VW diesel engine vehicles sold in the U.S. violated U.S. environmental laws, and it is seeking damages of up to $37,000 per car.
VW is fighting to regain consumer trust, and that won't happen overnight.
If you look at how corporate crises are resolved, it takes billions of dollars, it takes years of time, and it takes eventually introducing new products that people are excited about. So you can't judge a patient mid-surgery.
Diess told Al Jazeera the company will try hard to win back confidence.
And how do you convince consumers once again that Volkswagen is really a trustworthy company?
Yeah.
How do you do that?
Yeah, this will be a lengthy process. We have to stick to what we say. We have to deliver, and it starts with fixing the problem.
The e-Golf will be in VW showrooms later this year. The Bud E probably won't be for sale until the end of the decade. By then, VW executives hope they will have repaired credibility with governments and consumers.
And that is our show for this week, but there's more for you online at aljazeera.com/CTC. That'll take you straight to our page with individual reports, links and entire episodes for you to catch up on. You can also get in touch with us by tweeting me at KamalAJE. Do use the hashtag AJCTC when you do, or just drop us an email. countingthecost@aljazeera.net is the address. That is it for this edition of Counting the Cost. I'm Kamal Santamaria from the whole team. Thanks for joining us. The news on Al Jazeera is next.